Hello trading friends and welcome back to Forex Focus, brought to you by tastyfx. Going deep on Swiss franc here today in light of the bullish price action we're seeing in this safe haven, flight to quality, whatever you want to call it. Swiss franc getting bid up amid a bunch of volatility, not only in the Forex market, but especially in the equity market, commodity market, coming out of some recent data releases and news, a lot of which in the US, but also globally, has been the trend over the last handful of weeks here, causing the US dollar and a host of other, what we might call risk-on currencies to fall, and some of the more risk-off currencies like your Swiss franc and also Japanese yen. We've done a bunch of content on Japanese yen recently. You can go take a look at that. But today I do want to focus on the franc because we're seeing some crazy price action, some price levels that are approaching extremes that we haven't seen for years. And with this price action, we have a dollar franc market that is now close to 85 cents here, crashing under previous lows for the last several months. This market has held up above 88 cents really from April to August here, to late July, whatever you want to call it. In the last couple of days, seeing significant downside in the dollar, upside in the Swiss franc on a host of weak US data, and also just an overall flight to quality tone, a bearish tone for risk on assets over the course of the last week or so, which is crazy because if you go back to even the middle of July and look at some risk on markets like your S&P and your NASDAQ, but also the Australian dollar is often quoted as one of the major risk on currencies. Those markets were near either all-time highs if you're looking at equities, or recent highs for the last several months if you're looking at Aussie and some other non-equity risk-on markets just a couple of weeks ago. And now you're seeing this total shift in sentiment into a more bearish mode for those equities and risk-on assets, but a very bullish mode, as you can see here, for risk-off assets or flights to quality like that Swiss franc. So what's changed? We've got the trend of worsening data, but that's kind of been going on really since the peak of GDP growth and great earnings that we saw a couple of years ago. Why are we starting to feel fearful now, especially? Well, the employment data is starting to show that not only are things normalizing like we saw in much of 2023 and the early part of 2024, inflation came down, if you'll remember, but GDP and a bunch of other metrics actually held on to be, all things considered, positive, even as interest rates rose to fight that inflation. Now we're starting to see that sentiment turn from, let's say, positive in the 2021-2022 timeframe to more or less neutral in the 23 to early part of 24 period. In the last couple of months here, potentially negative. You have here, looking at the unemployment rate in the US, and of course there's a bunch of metrics that you can look to, but the employment data has really been what sparked this emphatic, fearful tone that we've gotten in recent trading. So let's hammer on this for just a second. The last three readings here for the unemployment rate in the US have been unexpectedly higher. And now getting to 4.3%, that is the highest unemployment rate from the US in the last couple of years. And so everyone's starting to think, okay, the inflation story is over. Are we now dealing with a potential recession on the back of the first 5% plus interest rate environment that we've seen in more than a decade? Were interest rates too high for too long, and now they've done irreparable damage to the economy? And sure, we're going to look at the odds on rate cuts coming at the next meeting, and they're overwhelmingly likely that the Fed is going to cut at the next meeting. Maybe we'll even get a surprise cut before that if the data continues to come out poor over the course of August. But people are now becoming worried that we waited too long. And even if they do cut rates by 25 basis points, 50 basis points, 100 basis points over the next handful of months, that this trend has already kicked off and it might get worse before it gets better. Let's take a look at stock volatility, because this is another market that is really pointing to signs of further fear, further downside in equities and risk on markets. And it's always interesting to me, and we're going to crunch some numbers on correlation between VIX here and the Swiss franc in just a second. But there's no one fear measure in the market or measure that tells you that the market's going to crash or anything like that. But you do have a host of markets that when they start to perform a certain way, that is a signal that fear's at least escalated and there might be some more downside to come. VIX obviously one of them, as this is the S&P 500 implied volatility index. When it goes higher, option prices on the stock market are increasing. When option prices on the stock market are increasing, that means that people are willing to pay more for insurance on that stock market crashing. And so you're seeing not only a spike in Swiss franc prices, but a spike in this VIX, or fear gauge as it's quoted oftentimes. And this index skyrocketed above 20 following the bad non-farm payrolls report. And at certain points during the trading day following this bad employment data, got all the way up above 25. And that's really the first time in the last year plus of trading that we've seen this fear measure get up there. I believe the last time that we saw fear measures like this was that regional bank crisis of more than a year ago. So interesting to see if this is the top in this fear measure, or if it continues, might also continue with the US dollar downside and Swiss franc upside. Let's take a look at the correlation metrics, because it shows some good stuff in here, but doesn't necessarily paint a perfect story for what we're getting at, although the correlation has turned here just today from negative to now neutral and potentially crossing over into positive territory by the time you're watching this. This is the correlation between that VIX index, so stock volatility index, and Swiss franc versus US dollar prices. And you haven't seen a lot of green in the last couple of years, but you also haven't seen a lot of bearish markets or fearful tones out there amongst equities and commodities and everything else. You go back to the pandemic, as we've highlighted here, strong positive correlation of almost positive 0.5 between the Swiss franc currency and the S&P 500 IV index. I mean, for cross asset class correlations, that's pretty strong. Go back to the Chinese stock market crash of 2015 into 2016, and it was even higher at that point, climbing up past positive 0.5 correlation. What does this tell you? Well, it tells you that Swiss franc, when there's not an overarching theme of fear in equities and beyond, doesn't have a high correlation to equities or the equity implied volatility index here. But when there is a time of fear or bearishness in the market, this Swiss franc does tend to move higher and lower with that fear. It's viewed in times like this as a safe haven or a flight to quality. When we see stock market crashes or, like I keep coming back to, fearful sentiment in the market, we tend to throw out a lot of what the Swiss National Bank is doing or how the Swiss economy might be measuring up compared to the euro area or how those normal dynamics go. And we really focus on the Swiss franc and also the Japanese yen to an extent are historically safe havens or flights to quality and can see large bids when the fear in the market is escalating. And a couple of good examples of that with the 15-16 Chinese stock market crash and the pandemic, obviously, of early 2020. If this story continues to develop, we continue to get poor data, maybe slip into that recession territory, then you might see this correlation get back strong again, and maybe that VIX and Swiss franc continue higher. Let's take a break from the equity Forex talk to talk about interest rates and how this is shaking out there. We've talked about this on the program before. Always a tough idea cutting interest rates. Very few examples, especially in the last 30 years, of a central bank like the Fed, a major central bank, cutting interest rates significantly, and that coinciding with positive stock market price action. Theoretically, everybody's been calling for interest rates to be lower in the U.S., especially those long stock market position holders, because theoretically, lower interest rates means easier access to capital for growth companies and potentially more growth and higher earnings for those companies, and thus maybe higher market capitalizations and valuations of those stocks. In practice, it's usually different, right? The Fed tends to lower interest rates when they have a reason to, and now that reason is a potential recession. And so it's almost a catch-22, if you will, that you want this interest rate lower from the Fed, but do you really want what it's going to cost to get the interest rate lower? And really, really crazy price action in interest rates following this poor employment data. Now there is more than a 90% chance that U.S. rates are lower by 100 basis points or more by the December meeting. There are only 3 scheduled meetings left, and they tend to only cut or raise rates by 25 basis points. And so this market is essentially saying we either think a surprise rate cut is coming, or they're going to cut by 50 basis points or more at one of these meetings, which they don't traditionally do. This is really starting to look like this market is not only a little fearful, but could be really fearful. You look at this distribution, and there's 36% focused around that 425 to 450 interest rate range. Right now, we're at 525 to 550. And so there's essentially around a 50% chance that rates are lowered by around 100 basis points. But what's really, really interesting here is that there's now more than a 50% chance that the market thinks today that interest rates will be lowered by more than 100 basis points by December. So that would be potentially either 1 or 2 surprise rate cuts, or at 2 of the 3 meetings, 2 50 basis point cuts, which again doesn't tend to happen. We only get these big rate cuts around big events like the pandemic of 2020. We saw a 50 basis point cut and I believe a 75 basis point cut. So really interesting to see not only Swiss franc rising in price, VIX rising in price, but these Fed fund futures not only pricing in what we saw the last couple of weeks, which is, okay, maybe 50 basis points, 75 basis points lower. And that makes sense because they can cut in September and November, or September and December, or all 3 of them by 25 basis points. This market in a little bit of a freak out mode, thinking that there might be multiple 50 basis point cuts or even a surprise cut from the Fed, which would be the first since the pandemic. So we'll continue to monitor that, and we'll continue to monitor these dollar prices as well, because getting back to the dollar Swiss franc here, we have seen lower prices in recent price history. You'll remember at the end of 2023, the US dollar saw a really big slide against most major currencies, but in this dollar franc pair, we saw this market get down to 84 and even break that 84 cent level for a handful of trading sessions at the end of the year there. Right now, we're less than 200 pips away from that price level. And that is actually the low going back the last 8-9 years here that we have data for. This price tends to trade in the 90 cent to $1 even or parity level. We're getting really far away from that, and we're potentially going through the lows here. And so where next for this US dollar? It has been lower, and it can get lower here. Obviously, it can do whatever it wants, but getting really close to these historic price extremes will be interesting to see if we continue to get this Swiss franc bid tone if equities sell off. If there's a bounce back in the S&P and NASDAQ, maybe this US dollar bounces back with it. Only time will tell. We'll continue to monitor the economic data and all the price action across asset classes. Thanks for watching.